And we welcome back to the show Dan Geltrude, nationally renowned CPA. Good morning, Dan. How's everything going?
Good morning, King. Very well, thank you.
Oh, excellent, and a very informative segment that you have every single week on this program. We talked about IRS audits last week, and someone off the air asked me about that topic. So let's start with this question for you. How does the IRS contact you if you are being audited, and will the IRS ever call you on the phone?
Good question, King. First, if you're ever selected for audit by the IRS, you are going to be sent a letter. You're not just going to get a phone call out of the blue. And once you get that letter, as we've talked about in the past, that's time to go through the various steps, starting with retaining representation. As far as the phone calls related to the scam that's been going on for quite some time related to the IRS, what they're doing is they call you and they basically demand payment. They tell you that you owe taxes and that if you don't pay the tax, they're going to call law enforcement, have you arrested. So it's really a threatening type of phone call. And what they're asking for is payment with a prepaid debit card, or they want your credit card numbers. They'll even take your iTunes gift card. They'll take any type of payment. So if you ever have that type of situation, you should realize that the IRS is never going to call you, demand payment like that. You should just hang up.
There was a Seinfeld episode where Jerry is audited because of a shaky charitable donation. It wasn't an actual real charity. So let's discuss charitable donations. I know it's not as easy as just giving cash or clothes to someone, then being able to deduct it. If you get audited, you have to prove what that donation was. So what are some of the rules of donating? How do you make sure that you don't have any IRS problems when you're trying to do a good thing and give to charity?
To start with, you must be donating to a qualified organization. And what does that mean? It would have to be a religious organization like a church, synagogue, a veterans organization, or an educational organization. And keep in mind, there are some organizations that never qualify. So donations to a social club, political donations. We all may have a friend or two that seems like a charity, but if you give them money, that does not qualify. And as far as your reference goes to Seinfeld, your donations to the Human Fund are also not going to be tax deductible. So let's talk about what you have to do when you are making those donations. If you make a donation over $250, you must have a letter from that organization that's dated and clearly lays out the amount of your donation. You also want to keep a copy of the check. And those are records that you absolutely want to keep because under audit you will have to produce those. Also, if you receive a benefit from donating, like you go to a charitable dinner that's raising money for a cause, if you have to figure out, or sometimes they tell you what the value of that meal is. So if the cost of a ticket is $100 and the value of the meal that you're getting is $30, you only get a tax deduction for the difference, which would be $70. Also, when you're donating property, keep in mind that it's at the fair market value. It's not what you paid for it. So that means that it could be higher or lower in terms of the amount you can deduct compared to what you paid for it. And also, items that are valued over $5,000, those generally require an appraisal by a qualified appraiser.
Okay, how about if someone gets divorced? Are there any tax benefits? For instance, can you deduct alimony and or child support?
Okay, so for divorce, some really basic rules. Alimony payments are deductible. Alimony receipts are taxable, and child support actually has no tax effect. So when we talk about alimony payments, which are deductible, those are by the divorce decree or by court order. It's not what you pay per se. It also has to be supported by what you're required to pay. you also have to make that payment either by cash or check. If you're short a little bit on cash and you decide you're going to give your spouse your car, that's not going to qualify as a deductible alimony payment. You also can't front load your alimony payments because let's say your tax situation would really benefit you to have a large alimony tax deduction. So you say, you know what, I'm going to double my alimony payments this year to get a tax benefit. You can't do that. It also, the alimony payments have to end upon the recipient's death. The two spouses must be living apart, and they can't file a tax return jointly. As far as receiving alimony payments, the recipient spouse may actually want less alimony and have that allocated to child support. Why? Because they're going to have to pay tax on the alimony they receive, yet the money that goes to child support is not going to be taxable. So again, the child support aspect of this has no tax effect.
Okay, I think that's cleared some things up. What about being self-employed from a tax standpoint? If you own your own business, can you deduct all of your costs as business expenses? And in particular, how about transportation?
You know what happens there? We've talked about in the past that sole proprietors or sole owners of a business have a higher chance of being audited, and that is because people have really abused that area by, as you just mentioned, deducting all of their expenses as business expenses. You are allowed to deduct business expenses for your business, not personal expenses. So there are some things that you can get benefit of if you're self-employed. For example, your individual retirement plans, your IRAs or 401ks, the contributions into those are tax deductible. The business use of your home or your apartment, if you have a space in your home that you have allocated strictly for business, you are permitted to deduct all of your home expenses which pertain to that specific area of your house. As far as travel, you are allowed to deduct your automobile expenses, and specifically the advantage there is you can take depreciation expense on your automobile, again, as long as it's being used for business. You're also permitted to take depreciation on property and equipment that you've purchased for use in your business. And then you could also get deductions for educational expenses. In some fields, you're required to take various continuing educational courses. You can deduct those expenses.
And Dan Geltrude with us, CPA extraordinaire. Every Saturday morning at 7:45 a.m., he shares his expertise with you. And clearly, Dan, you know, you're a CPA at the elite class, renowned nationally as being an expert in all fields about money and taxes. So are some of our listeners, are they missing out on deductions that they would be entitled to because their accountant isn't up to par, or because they just go to, say, a national tax preparer who maybe just got out of training somewhere? What are some of the deductions our listeners may be missing out on?
Sure. First, let's keep in mind that state sales tax, if it's greater than your state income tax, certainly not New Jersey, but if you're in another state where they don't have state income tax, the sales tax is deductible if you're itemizing on your tax return. So that's one commonly missed deduction. Let's also keep in mind that there's no tax on your state income tax refund from the prior year if you didn't itemize. Usually, you're always thinking, well, your state income tax refund from the prior year, you need to pick that up subsequently as income. Not always true. How about this one? Student loan interest paid by the parents, okay? The child can deduct that interest as long as they're not a dependent up to $2,500. Also, moving expenses for your first job. So you graduate from college and you end up getting a job that's more than 50 miles away from where you live. Even if you don't itemize, you're allowed to deduct that. So that's another one that people tend to overlook. Mortgage points. If you qualify, you can deduct them all in the first year. Casualty losses. Okay, so if you end up in a situation where you have a natural disaster, whatever is not covered by insurance, you are allowed to take that as a casualty loss. And finally, there are some adjustments or rather deductions that you can take related to energy. So if you end up putting new insulation in your house, as an example, you can end up with a tax credit.
Another great segment of Dollars and Cents with Dan Geltrude. Check out Dan's website, Geltrude.com. Also a great YouTube page where a lot of the segments that we've done are up there, and a lot of the Fox News and other great segments Dan has done on TV up there. Dan, thanks so much for the information. Our listeners greatly appreciate your segment each and every week. And have a great week. We'll talk to you next Saturday.
Great. Thank you, King.
Thank you so much.